Russia earned 58% more from energy exports in June than in January. Its oil and gas tax revenue fell 38% from a year earlier. Both numbers are official. The first comes from tanker tracking by the Center for Research on Energy and Clean Air. The second comes from Russia's own finance ministry. The gap between them is not an accounting quirk. It is the arithmetic that decides how long a war economy can be funded. And in April, the International Monetary Fund raised its growth forecast for Russia to 1.1% for 2026, up from 0.8% in January. An economy widely described as broken is being revised upward. If you only watch the export figures, you would conclude the pressure had failed. If you only watch the Treasury, you would conclude collapse was weeks away. Neither is what the ledger says. Answering the question properly takes 3 quantities and 1 subtraction: what the exports earn, what the war costs, and what sits in the reserve that covers the difference between them. That reserve has a name: the National Wealth Fund, and only part of it can actually be spent. That spendable part is now worth 1.5% of the Russian economy. A war economy is a budget reorganized around one line item. Russia crossed that threshold in stages. In 2022, oil and gas supplied 42% of federal revenue. For 2026, the budget plans for 22%. The state's oldest income source has been cut roughly in half as a share of the whole. Military spending moved the opposite way. In the first quarter of 2026, Russia spent 5.9 trillion rubles on the military. That is 46% of all federal spending, nearly 1 ruble in every 2, and 30% more than the same quarter a year before. Those figures come from economist Janice Klug's reading of finance ministry data published by the Institute for the Study of War. The budget law had planned the opposite. It called for defense spending to fall this year from 7.8% of GDP down to 6.2%. The first quarter alone consumed 2.5%. So how big is that, measured against everyone else? The Stockholm International Peace Research Institute puts Russian military spending in 2025 at $190 billion, 7.5% of its economy. World military spending averaged 2.5% of GDP that year. Ukraine, by comparison, is at roughly 40% of its own GDP. But measured against its own income rather than its economy, the ratio is starker. In the first 4 months of 2026, military spending came to roughly 2/3 of everything the federal budget collected. And a share of GDP does not pay soldiers. Cash does. In the first half of 2026, Russia's federal deficit reached 5.7 trillion rubles, 2.5% of GDP. The budget law had planned for 3.8 trillion across the entire year. 6 months in, the annual plan had been exceeded by half again. That is the number that starts the clock. Follow 1 barrel from a Russian loading terminal to the Federal Treasury, and the mechanism appears. The barrel leaves Novorossiysk or the Baltic and sells at the Urals price. In June, that averaged $63, a 28% discount to Brent, about $24 a barrel below the global benchmark. 54% of that seaborne crude moves on sanctioned shadow fleet tankers, which cost more to charter and more to insure. The intermediaries changed too. In October 2025, the United States sanctioned Rosneft and Lukoil, the 2 companies that between them handle most Russian crude. The measures took effect that November. Volumes were rerouted through smaller traders, which is possible, but not free. Every additional hop between the wellhead and the buyer is a margin taken by someone who is not the Russian treasury. Then, the currency changes hands. And this is where the money quietly disappears. The barrel is priced in dollars. Russia's largest oil tax is levied in rubles. Salaries, Contracts and ammunition are paid in rubles too. So the exchange rate is not a detail in this system. It is the conversion step. The 2026 budget was written assuming 92 rubles to the dollar. The Economic Development Ministry now forecasts about 81.5. The ruble was the best performing currency in the world in the first quarter. Every ruble of strength shrinks the tax take from an unchanged dollar sale. That is why the number you see quoted, export earnings, in euros, rising, and the number the Treasury actually needs, tax receipts, in rubles, have come apart. So who is actually paying for it? Start with who is buying. In June, China paid 7.3 billion euros for Russian fossil fuels. India paid 5.5 billion, a record month for crude. Turkey, 2.3 billion. The European Union, still 1.9 billion, most of it liquefied natural gas. Saudi Arabia bought 800 million euros of refined products. That flow is why the barrels keep moving. It is also why the price you pay at the pump is lower than it would be if those barrels stopped. Now, the other side of the ledger. With oil covering a smaller share of the budget, the difference has been shifted onto domestic taxpayers. On the 1st of January, Russia raised value-added tax from 20% to 22%. The finance ministry expects that to bring in an additional 1.2 trillion rubles. Most small business exemptions were removed at the same time. By July, the tax burden on Russia's non-resource sector had reached a 15-year high. So how long does the model hold? Two readings of the same ledger. The depletion case rests on the liquid cushion. Russia's National Wealth Fund holds assets it can actually spend, foreign currency and gold, separate from illiquid stakes in domestic companies. On the 1st of July, that liquid portion stood at 3.6 trillion rubles, 1.5% of GDP. In January, analysts at Gazprom Bank's Center for Economic Forecasting published the arithmetic. Their model draws the fund down whenever oil sits below $59 a barrel, the budget's own baseline. At around $40, they estimated the liquid reserves would last roughly 1.3 years. At $30 to $35, they could be gone by the end of 2026. At $50, about 2.5 years. Those are scenarios with stated assumptions. They are not forecasts. Change the oil price and the answer changes with it, which is exactly the point. The fund is not a deadline. It is a dial. The sustainability case rests on everything the fund is not. Russia's federal domestic debt sits at roughly 15% of GDP, a fraction of what most developed economies carry. The central bank has been cutting rates, down to 14% in July, and the International Monetary Fund has been revising Russian growth upward, not downward. On paper, there is room to borrow. The counter arrived in the same month. In July, the finance ministry suspended its government bond auctions after prices fell and yields rose. A Sberbank executive said the banks did not have the cash to absorb more government debt. Borrowing headroom on paper is not the same as buyers in the room. Here's what holds regardless of which reading is right. The war is no longer financed the way it started. In 2022, oil and gas carried 42% of the federal budget. This year, the plan is 22%. The difference has been made up by value-added tax, by removed exemptions, and by a tax burden on non-resource business at a 15-year high. Whatever happens at the front, that shift has already happened. Its cost shows up far from the oil fields. Russia's economy contracted 0.3% year-on-year in the first quarter, its first quarterly decline since early 2023 on the Center for Eastern Studies reading of the data. Construction fell 10%. Heavy truck output fell more than 30%. Military production expands. The civilian economy underneath it does not. Those two facts are not independent. Every worker, every machine tool and every ruble of credit routed to one of them is unavailable to the other. And that trade does not reverse on the day the shooting stops. Which brings us back to the two numbers we opened with. 58% more earned from exports, 38% less collected in tax. They were never in contradiction. One measures what the world is still willing to buy. The other measures what the state manages to keep. The discount, the shipping, the sanctions, and the exchange rate all live in the space between them. So the question is not really about oil. It is about how much of each barrel survives the trip from the buyer to the budget. Right now, less of it survives every month, and the fund that covers the difference is 1.5% of an economy at war.